A conventional loan for a gas station is a commercial real estate loan that's not government guaranteed like an SBA 7A or 504 or a USDA rural development loan. Conventional loans are originated by banks, credit unions, and insurance companies. Conventional lending certainly has its advantages and disadvantages. In reality, a loan from your local bank might very well be your best deal. Because they're local, frequently somebody from the bank will go by and look at the property. If it's from a local lender, the approval process and closing process can typically go faster. The bank will typically require a depository relationship, and if it's an unbranded station, some of them might even want a merchant account relationship. A clear advantage of conventional loans for gas stations is the interest rate. In general, an SBA loan will usually be higher than a conventional loan. The SBA 7A loans are generally priced between 1.5 to 2 3/4 over the prime rate and are a floating rate. Conventional loan pricing will vary from fully floating over prime like the SBA 7A to loans at fixed rates for the life of the loan term. Typical loan quotes from conventional lenders will be fixed for a period of time between 3 and 7 years, and the rates will be reset after the initial 3 to 7 year period. SBA loans are generally structured with longer amortization schedules for a real estate transaction, and a 25-year amortization is the most common. The SBA loan terms generally match the amortization schedule. Conventional loan term will vary between 5 years and 10 years, and the loan amortization schedule will generally be between 10 and 20. Some conventional lenders will amortize their loans on a 25-year schedule depending upon the age and the useful life of the property. One of the disadvantages of conventional loans are potential covenants that are contained in the loan agreement or the promissory note. Conventional real estate loan covenants may include minimum liquidity requirements, minimum debt service coverage ratios, maximum loan-to-value ratios, and required periodic financial reporting. The bottom line is the bank can call the loan during the term of the loan. Compared to a government-guaranteed loan, loans generally are not called with the exception of fraud or a monetary default. Another disadvantage of conventional loans is the lower loan-to-value or LTV advance ratio versus an SBA loan. Conventional loan-to-value ratios are generally at a maximum of 70 to 75% of the appraised value of the property as compared to SBA loans, which can be at 75, and in cases up to 80, 85, or even 90%. Keep in mind, conventional lenders will, in general, not finance the intangible values of a property such as goodwill, which can be as much as 10 to 15% of the total asset value. Unlike the SBA, there are multiple indexes that banks and credit unions use, such as the Treasury's Federal Home Loan Bank Rate, Prime, SOFR, to name a few, so it's more flexible that way. Conventional loans will normally require a higher debt service coverage ratio than on an SBA loan. An SBA loan can have a minimum debt service coverage ratio of 1.1 to 1. A conventional loan will normally require a minimum debt service coverage ratio of 1.35 to 1. Combine that with a shorter amortization schedule, and conventional is more difficult to qualify for. The debt service coverage ratio, or DSCR, is generally defined as the property's net operating income divided by the sum of all debt payments of interest, principal, and lease payments. It's a standard covenant used in the measurement of an entity's ability to produce enough cash to cover its debt payments. Large dealers or multi-store operators may only qualify for conventional financing because of the size of their company or the size of the loan request. The SBA limits companies with significant revenues from qualifying for inclusion in the 7A or 504 programs. This SBA also has limits on the amount of loan guarantees that they will provide for larger transactions. There are other situations where conventional financing is clearly the only option. Many fuel suppliers are not in the SBA franchise registry and are therefore ineligible for financing for the dealers. Fuel supply agreements from many of these major oil companies may have deed restrictions, brand covenants, or rights of first refusal, or ROFR, clauses that would make the property ineligible for SBA guaranteed financing. Conventional lenders can structure their loans to mitigate the restrictions, but not in all cases. Finding a conventional lender is more difficult in general than finding SBA lenders. Financing retail petroleum properties is a specialized category of retail financing. Conventional lenders have to understand the many unique aspects of petroleum retail lending, including issues involving environmental testing and compliance, fuel supply agreement requirements, inventory management, liquor and beer licensing compliance, among others. Although there are at the moment a growing number of national lenders providing financing to the retail petroleum industry, they are not consistent with their lending policies. Many of the national lenders require the borrower to own at least 15 C-stores and will require the borrower to refinance all existing debt to get access to new debt capital for expansion. Conventional lenders will often insist on a depository account, which should not be an issue for smaller C-store operators, but more complicated for multiple store operators. When all is said and done, you'll need to make the determination if the conventional loan advantages outweigh the advantages of government-guaranteed lending. PetroMAC has a history of working with national lenders and with regional and local lenders, so we know what are the right options for a borrower. PetroMAC has a long track record evaluating all situations in the retail petroleum industry and providing the right solutions for the borrower. Thank you so much for listening.